Jay Powell's message was that the markets shouldn't react to the idea of higher rates, but they already did, and the futures are already reacting to that today as well. And I've never met a market that liked the idea of higher rates or rate moves that would be sooner than expected. So what the market obviously is going to do is look out into the future and say rates might move before we thought. But here's the real message. When we expected rates not to move up until the end of 2023 or maybe even 2024, I think that was a little naive. The economy is not in an emergency situation anymore. And as we move through 2021, yes, rates likely stay at zero, but we get into 2022 and maybe we start creating more organic growth. We've got inflation that finally lifted off the ground. We've got a job market that, if we meet the Fed's projections, is pretty healthy. So I think rates do eventually have to go up, and before originally projected. This is not bad news.
Well, the bond market could do the work for the Fed, as they have, the so-called bond vigilantes, Liz. And we know there was a big jump in yields from November to March. That some thought was sort of a pre-taper move by the bond market. We've been stuck pretty much since mid-March on yields. Do you think the bond market is going to wait around for another, 18 months, 24 months?
I hope it doesn't, because what we want as investors is for markets to make sense with the economic data. And we already saw a pretty big move in the 10-year yield as a reflection of the idea that rates might go up and that the economy is doing better. I think the rally in the 10-year yield over the last month or so has been something that doesn't really add up. So I'd like to see the 10-year drift upwards, but the key word there is drift. Spikes in yields are something that really confuse markets. They tend to send equity markets into a little bit of a tizzy. So you want to see rates slowly drift upward, and that would be positive for rate-sensitive sectors like financials, who are going to make more money as the curve steepens. There's also probably a lot of investors out there that were expecting a curve to steepen. So over the next 6 to 12 months, I do think that rates continue to go up. I just hope they do it in a controlled fashion.
Do you think there's a chance that we've been kind of conditioned, Liz, over the last decade or so that low rates good, higher rates bad, but that's not always the case. Do you think there's a chance that the Fed may have to reverse course? I mean, just because they project something doesn't mean that's what they're going to do. I project I'll have more hair next year than this year, but that's probably not going to be what happens. Is there a chance they could do more damage to their goal of maximizing employment or controlling prices than good from this ultra low rate for longer policy?
Well, I think that's the line that Jerome Powell and the rest of the committee has to really dance around, because there is a risk in being too slow to act. There's also a risk in doing it too quickly. And what they really don't want to do is cause another taper tantrum or cause an overreaction in the market because there was a move that was too soon. I think, and I continue to say this, I think this Fed is going to err on the side of being too late, rather being too late than too early. And we heard that same message yesterday. Don't expect a rate increase anytime soon. The tapering message continues to be consistent. I think we were expecting to get a little bit more information about that taper yesterday, but we'll still likely get it in fall. I think the Fed will continue to be really patient here. And we also have to keep in mind, they keep talking about this average target. If we assume, and this is just me assuming just for simplification, that it's a 2-year average, core PCE is still only running at 1.59, 1.6% on a trailing 2-year average. So there's nothing in the data that's screaming at the Fed to act anytime soon.
Because if you look at a trailing 2-year average like they do, of course the numbers are going to be skewed. That's the problem, is the data from last year is so out of whack. We started normal, absolute lockdown in many states. The economy tanked, then the economy came back. Can we look backward and get any guidance at all? That's my problem, Liz. I don't understand how we should look at 2019 numbers, right? Don't even look at 2020. Almost look at 2019 and 2021, not just from the economy, but from earnings. Or is that just 5 a.m., crazy talk?
I absolutely agree with that as far as an earnings perspective. From an inflation perspective, I mean, inflation was still low in 2019 as well. So these numbers, earnings, inflation, a lot of the economic numbers that we see are going to look toppy. They're going to look hot. Everything is going to look like a peak when we compare it to a trough. So yes, it's true that all of the data is going to look skewed as we, especially this kind of late spring, early summer timeframe. But what we have to really also keep in mind is something that came out of the meeting yesterday. If the expectation is that inflation runs a little hotter than 2% and the Fed is okay with it, some of those votes on the dot plot actually looked like they would move rates when inflation got just slightly above 2%. So I think the buffer that we had in mind changed as well, and that's what the market is trying to digest.
Shepard Smith here. Thanks for watching CNBC on YouTube.